Hello and welcome. Today, we're going to deconstruct the core principles of personal taxation here in Canada. Our goal is to give you a really clear foundation, whether you're a student, a professional, or brand new to the country.
This explainer has been prepared to provide a structured and hopefully very accessible overview of what can be a pretty complex topic. So let's get started.
Before we discuss any numbers, any forms, or any deadlines, we have to start with the single most important question in Canadian tax. Are you a tax resident? Because your answer to this question, well, it determines the entire scope of your tax obligations.
So here's our roadmap for today. We're going to build our understanding from the ground up, starting with that cornerstone concept of tax residency. Then we'll move into what income gets taxed, how that tax is calculated, and of course, how to lower your tax bill. After that, we'll look at some tax-smart savings accounts and finish up with the filing essentials you need to know.
Okay, let's dive into this first crucial concept. This really is the starting point for all Canadian tax implications. It answers one fundamental question. Does the Canadian tax system apply to your worldwide income or only the income you earn right here in Canada?
And here's the fundamental difference laid out clearly. If you're a tax resident, you're taxed on your worldwide income. That means income from your job in Canada and rental income from a property you own abroad. It's all part of the same picture. But if you're a non-resident, you're only taxed on the income you actually earn in Canada. It's a massive distinction.
So how is this residency status actually determined? Well, unlike some other countries that just use a simple day count, Canada focuses much more on your intent and your significant residential connections. We call these ties. The most important ones, the primary ties, are pretty straightforward. Where is your home? Where does your spouse live? And where do your dependents live? These factors are what the CRA looks at first.
So once we've established residency, the next logical question is, okay, what income is actually taxed? Let's explore the main categories that you'll need to report.
We're going to focus on the most common types. First, there's employment income, your salary, your bonuses, the stuff you'll find on your T4 slip. Then there's investment income, like interest from a bank account, dividends from stocks, or rent you collect. If you're self-employed, you'll have business income. And finally, there are capital gains, which is the profit you make from selling assets.
Let's just clarify what a capital gain is, because it's a really important concept. It's not the total sale price of an asset, it's the profit you make. So if you buy a stock for $1,000 and sell it for $1,500, your capital gain is $500. Now in Canada, you don't pay tax on that full $500. Instead, a specific portion of that gain, known as the inclusion rate, gets added to your income.
And this is a big deal. This table illustrates a major recent change. For individuals with capital gains over a $250,000 threshold, the rules changed in mid-2024. Before, the inclusion rate was 50%, meaning half your gain was taxable. Now, for gains realized after June 24, 2024, that rate jumps to 2/3. So a larger chunk of your profit is now considered taxable income.
All right, let's move on to the calculation engine itself. It's really important to understand that Canada has a progressive, multi-layered tax system. We're going to see how federal and provincial rules combine to determine your final tax bill.
Canada uses what we call a progressive or slab system. This means different portions of your income are taxed at increasingly higher rates. Look at the table. Your first roughly $55,000 of income are taxed at 15%, but the money you earn above that gets taxed at the next rate up, 20.5%, and so on. And remember, these are just the federal tax brackets. Each province adds its own layer of tax on top of this.
Now, here's a key distinction, especially for anyone familiar with the U.S. system. In Canada, there is absolutely no joint filing. Spouses file their tax returns individually. You each report your own income and claim your own deductions and credits on your own separate return.
So now that we know how tax is calculated, let's explore the two primary tools the system gives you to reduce the amount you owe. We're talking about deductions and credits. They sound similar, but they are very, very different.
It is absolutely crucial to understand this difference. A tax deduction reduces your total taxable income. Think of it as shrinking the pie before it gets sliced up by the tax man. A tax credit, on the other hand, comes at the very end. It directly reduces your final tax bill. It's basically like having a coupon you can apply to your final payment. This chart shows the impact perfectly. Let's say you have a $1,000 item. If it's a deduction and you're in a 30% tax bracket, it saves you $300 in tax. Its value is tied to your personal tax rate. But if that same $1,000 item is a non-refundable credit, its value is usually a 15%, the lowest federal rate.
so it only saves you $150 in tax. Big difference.
Okay, beyond those single-year reductions, Canada offers some really powerful registered accounts that are specifically designed for long-term, tax-efficient wealth building. These are your strategic planning tools.
First up is the RRSP. The whole game here is tax deferral. You contribute money now and get an immediate tax deduction, which lowers your current tax bill. Then, all the investments inside the account grow tax-deferred, meaning you don't pay any tax on the growth year after year. You only pay tax when you take the money out in retirement, when you're likely in a lower tax bracket.
Now, the TFSA is almost the exact opposite. You contribute with after-tax dollars, so you don't get a deduction up front. But here's the magic. Your investments grow completely, 100% tax-free. And when you take the money out, also completely tax-free. It is an incredible tool for tax-free growth.
And then there's the newest account, the FHSA. This is an amazing hybrid that gives you the best of both worlds. You get a tax deduction when you contribute, just like an RRSP. Your investments grow tax-free inside the account. And then, if you use the money for a qualifying first home purchase, the withdrawal is tax-free, just like a TFSA. It's incredibly powerful.
Finally, let's cover the practical side of things, compliance. Knowing the rules is great, but you also have to follow them. So let's talk about the key dates and obligations you need to be aware of.
You really need to remember these two dates. For most people, April 30th is the deadline to both file your tax return and pay any tax you owe. Now, if you or your spouse are self-employed, you get a little bit longer to file until June 15th. But, and this is so important, your payment is still due on April 30th. The extension is only for the paperwork. Here's one more critical reporting duty, especially for new residents. It's called the T1135 form. Now, this isn't a tax form, it's an information return. If you're a Canadian resident and the total cost of your foreign assets, things like property or stocks held outside Canada, goes over $100,000 Canadian at any point in the year, you have to report it. The good news is there's an exemption for your very first year in Canada.
And there you have it. We've covered the foundational rules: residency, income, how tax is calculated, and how to file. So, now that you know the basics, the real question is, what's your next step? Because with this knowledge, you can start moving from simply complying with the rules to strategically planning your financial life here in Canada.